Welcome to Debt-Free Dreams, the channel that empowers you to navigate the complex world of cryptocurrency and take control of your financial future. Today, we're tackling a hotly debated topic: is crypto a bubble? Understanding market cycles. Whether you're a skeptic who thinks crypto is overhyped or a believer in blockchain technology, understanding market cycles can help you make smarter, more informed decisions. In this video, you'll learn what defines a financial bubble, the key phases of market cycles, how to spot signs of a bubble in the crypto market, strategies to avoid common pitfalls and thrive in any market condition. By the end, you'll have a clear framework for assessing whether crypto is truly in a bubble or simply part of a revolutionary market cycle. Check the description for links to the best tools and resources to help you master the market cycles. Let's get started. Part 1. What is a financial bubble? First, let's define what a bubble actually is. A financial bubble occurs when the price of an asset inflates far beyond its intrinsic value, driven by speculation, hype, and irrational exuberance. 3 classic signs of a bubble include: rapid price increases. Assets skyrocket in value over a short period of time. Overwhelming speculation. More investors buy in, hoping to ride the wave. Unsustainable growth. Prices are fueled by emotions rather than underlying fundamentals. 3 historical bubbles: the tulip mania of the 1600s, the dot-com bubble of the 1990s, the 2008 housing market crash. Many skeptics argue that cryptocurrencies, like Bitcoin and Ethereum, fit this description. But is crypto really a bubble, or is it following the natural rhythm of market cycles? Part 2. What are market cycles? To answer that question, we need to understand market cycles, which consist of 4 distinct phases. 1. Accumulation phase. Characteristics: prices are stable, adoption is slow, and the market lacks hype. Crypto example: Bitcoin in 2010-2012, when early adopters accumulated coins at incredibly low prices. 2. Markup phase. Characteristics: growing adoption, media attention, and a surge in prices. Crypto example: the 2017 bull run, when Bitcoin skyrocketed to $20,000. 3. Distribution phase. Characteristics: euphoria peaks, smart money exits, and prices begin to stagnate. Crypto example: the weeks leading up to Bitcoin's 2021 all-time high of $69,000. 4. Decline phase. Characteristics: panic selling, sharp price drops, and skepticism returns. Crypto example: the 2018 bear market, when Bitcoin fell from $20,000 to $3,000. Part 3. Is crypto a bubble or part of a larger cycle? The case for crypto as a bubble: speculative behavior. Many investors jumped into crypto without understanding blockchain technology. Excessive hype. Meme coins and NFTs often trade at inflated prices, driven by trends rather than utility. High volatility. Massive price swings resemble the patterns seen in past bubbles. The case against crypto as a bubble: technological revolution. Blockchain has real-world applications, from decentralized finance to supply chain tracking. Growing institutional adoption. Companies like Tesla, PayPal, and major banks have embraced crypto. Market cycles are normal. Bitcoin and Ethereum have already survived multiple bubbles, bouncing back stronger each time. Verdict: while individual cryptocurrencies may experience bubble-like conditions, the overall market follows natural cycles tied to innovation and adoption. Part 4. How to navigate market cycles. Regardless of whether crypto is a bubble or not, you can profit by understanding market cycles and adapting your strategy. 1. Identify the current phase. Use tools like Glassnode to analyze on-chain data, such as active wallet addresses and transaction volume. 2. Avoid emotional decisions. During the markup phase, resist the urge of fear of missing out. During the decline phase, don't panic sell. Bear markets often create the best buying opportunities. 3. Diversify your portfolio. Avoid putting all your funds into one asset, especially speculative coins. Use apps like CoinStats to track multiple investments across exchanges. 4. Set clear entry and exit points. Use platforms like TradingView to identify key support and resistance levels. 5. Stay informed. Keep up with market news and sentiment by following reputable sources and using analytics tools like Glassnode. So, is crypto a bubble? The short answer: it depends on how you look at it. While certain coins or trends might be overhyped, the overall market reflects a technological shift with long-term potential. The key is understanding where we are in the market cycle and adapting your strategy accordingly. Smart investing is about staying informed, managing risk, and focusing on long-term growth. If you found this video helpful, hit the like button, subscribe to Debt-Free Dreams, and share it with your fellow crypto enthusiasts. Check the description for links to the best tools and resources to help you master the market cycles.